Well, it definitely is the end of an era. I think it is sort of like the end of this phase of big tech where you had this, unfettered growth where these business models were largely unassailable and they, were really just fighting to grow into their valuation and just generate more revenue to justify where they traded at. And now it's this next phase where they have to operate more like a cash cow business. And so, it's an acknowledgement that the growth is tapering. It's an acknowledgement that they're going to trade on a pretty tight band in terms of multiple, which means that they have to manage expenses much more tightly, which means that they can't have a really broad-based surface area in which to operate an experiment. You have to keep the experiments small. You have to manage your expenses. You can't have employees basically, run over the place. Management has to have a firm hand in dictating strategy and what people work on.
The public markets have been hit hard in 2022, and that's trickled down to the private markets. Inflation concerns, rising interest rates, and geopolitical issues have all contributed to a roller coaster stock market. Startups, especially those that benefited from a pandemic boom that's starting to cool, are feeling the pressure too. Valuations, particularly at the late stage, have started to dip, and startups say it's much more difficult to raise new funding in this environment. After a banner year for tech, layoffs are here. In fact, as of late September, more than 42,000 workers in the U.S. tech sector have been laid off in mass job cuts so far in 2022, according to a Crunchbase news tally. Alphabet and Google announced a staff on July 20 had its pause in hiring for 2 weeks. The information reported following news that it would slow hiring and spending through the rest of the year. Senior VP Prabhakar Raghavan said the pause would not affect offers that have already been made, but that the company isn't making any new offers until the pause ends. Tech companies as big as Netflix have slashed jobs this year, with some citing the effects of the COVID-19 pandemic and others pointing to overhiring during periods of rapid growth. Robinhood, Glossier, and Better are just a few of the tech companies that have notably trimmed their headcount in 2022. Meta let 60 contract workers go from Accenture. According to a report in Bloomberg, the staff were told over video call, and the unlucky employees learned that the decision had been made by an algorithm, say reports. The move chimes with CEO Mark Zuckerberg's recent comments that underperformers will be rooted out. Apple cuts 100 contractor roles across several regions, as reported by Bloomberg. The contractors worked in the recruitment arm of the company. In June, CEO Tim Cook stated that the company would be investing through the downturn, but that it would be more deliberate in doing so in recognition of the realities of the environment. In the latest episode of the All In podcast, the besties analyze the current economic situation, especially as it relates to the tech industry. Before we listen to them, please smash the like button and consider subscribing if you are yet to do so. Thanks for watching our videos.
So I think all of that signals that Jason, I don't think this is the end. I actually think it's the beginning, because these companies, Apple, Facebook, Google, maybe a little bit Microsoft, are the most sensitive to valuation because they are the most widely held, right? These are the equivalent of US Treasuries in the equity markets, the safest, most predictable safe haven in times of stress. If you want to own big, chunky cash flow generating businesses that, are relatively unassailable, you couldn't pick 4 better businesses than those. And so the fact that they see enough in the horizon to say that we need to batten down the hatches should be a warning to everybody else. It's another data point that, again, I said it last week, I'll go out on a limb and predict my equivalent November fall predictions. Last fall, it was that the markets were going to poop the bed. My prediction now is that I think the markets are bottoming and consolidating.
Yep. 100%.
And this is the time, I think, to start nibbling and start getting ready to really rip the money in. And I think there's enough signals every day that kind of like tell me at least that on the margin, it's time, because I think the markets do a reasonably good job of digesting news and then pricing the forward reality, right? Like today's price is really everything we already know. And so the real guess is what's about to happen in the future. And from my perspective, I'm actually starting to get a little constructive here. I think that when companies like Facebook really do this, and like if you think about it one way, the financial markets have always had this thing that we have called a Fed put. What does that mean? A put is essentially the right to sell something. And what market participants have always known for the last decade is that if things got very hairy, if there was uncertainty in the market, the Federal Reserve would, and they have, consistently stepped in to create a buyer of last resort. And so it always eliminated that last part of true, supply demand balance, because they would just come and say, don't worry. In many ways in tech, what the big tech companies were that. You could never really find what the true market clearing price for an engineer was, or what the true amount of expenses you should spend on office space or, free services. Because you always had these companies, which was an escalating arms race. If one company had a massage, the next company had gyms and massage and physical therapists, and the other company would have buses to take you to the gyms and massage and therapists, and the next company would have protein shakes that were freshly made. And it just kept escalating and escalating because the costs didn't matter. And they wanted, if nothing else, to get that marginal engineer or product manager or business person to work at their company, which eliminated the risk that they would actually start something to disrupt them.
Blocker strategy is very real. You should unpack
the blocker strategies is very real. So when you take this big tech put out of the market, you will get true price discovery, and you will find out what the real price should be for this kind of an engineer, that kind of a product manager. You'll find out what are the real expenses you need to bear in order to build a real lasting business. And you'll be able to sort through all of that stuff out. So I think it's a really good moment. And again, it's yet another indication to me that I think, broadly speaking, the markets are now starting to stabilize. All the irrational behavior is starting to exit the system. The party is in the last few hours. Volume's going down. The alcohol is being taken away. People are hanging around with a little bit. Lights are coming on. They're like, I've been here a little too long. And I think that that's a very healthy process for an economy. And I think that that's what's happening right now. So I'm constructive. I'm a little bullish. I'll go out on a limb. I think, we could be 3 to 5% from the lows, but we're more near the lows than the highs.
The big takeaway here is just that nobody is safe. And it's not just startups that have to, tighten their belts. It's these big companies too. And I think we're headed for a broad-based recession. That's what it seems like. You saw Druckenmiller's comments this week predicting a hard landing in 2023. No one's talking about soft landing anymore. In fact, I think we're all wondering who's flying the plane. So I think we're headed for a pretty big recession. And I just take it in a slightly different direction. I'm down here in LA. Had dinner the other night with a friend who's a showrunner in Hollywood. And so a showrunner basically is like the head writer, and they basically put together the writing team and the content for a show, and then they sell them to networks. He said that no one is buying anything anymore here. That last year there was tremendous activity, and you saw the Game of Thrones guys, D&D, they got like a $300 million deal from Netflix, and Shonda Rhimes got a $300 million deal.
They did, yeah.
Yeah, they got there were massive multi-$100 million deals being made last year. And that was just for future writing deals. Netflix wasn't even buying libraries when they did those deals.
They were locking down talent for the next decade.
Yeah, exactly. So all of that has stopped. And the reason is that Netflix's stock has been hammered, right? And not only so they not have the capital to do those kinds of crazy deals anymore, but they know that Wall Street is watching them. And so fundamentally, they're questioning whether their business model even works if they have to spend that much money on content. So then all of Netflix's competitors basically have stopped. So this whole frothy environment that you had in Hollywood last year, that's just over. The faucet's been turned off, and it's not even turned off to a trickle. It's just stopped. So you think that this massive asset bubble that we had last year was just in crypto and growth stocks. It's not. I think it actually trickled down into the real economy because Netflix was one of those growth stocks. The money then flowed into writers in Hollywood and then lots of other places. This is one small example, right? That this asset bubble wasn't purely just something that's going to be localized to crypto. It affects real people in the real economy. And we are just beginning to see the unwind of that.
And by the way, we will also relive what we have empirically known to be true, and it's been pretty well proven. The investments that one makes in this period will probably be the best for many, many years to come because they'll have the most asymmetric upside. And that was true in 2008 and 9 and 10. It was true in 2002, 3 and 4. You're talking incredible companies just in those two periods. Think about this: Atlassian, Tesla,
Uber, Google,
Airbnb, Uber, Instagram, WhatsApp. Incredible businesses that have created tremendous value. And so there are businesses that have been invested in for the first time in 2022 and will be invested in for the first time in 2023 and 24, which will be the leading winners of this next phase and this next leg up. And so the real opportunity is to find out who those companies are and get behind them, I think.
100%. As I always tell people, fortunes are made in the down market. They're collected in the up market.
Founders and investors are preparing for what looks like an economic downturn and perhaps even a recession. In May, Y Combinator sent an email to its portfolio founders warning them to plan for the worst. The startup accelerator cautioned that the downturn would likely most affect international companies, asset-heavy companies, low-margin companies, hard tech, and other companies with high burn and long time to revenue. The tech redundancies are coming thick and fast in 2022, and with experts predicting a global recession on the horizon, we could unfortunately expect to see a few more in the last few months of the year. Our best advice to our viewers is to try and reduce their spending at this point and try and save as much as possible for the coming recession, which many experts believe is unavoidable. Thanks for watching our videos. Please stay savvy till our next video.